All right, this is being recorded, you guys. One thing I say at the beginning of every single webinar is watch this again relatively soon afterwards. For one, it's going to put it into your long-term memory. You'll remember the nuances that I'm talking about longer. And the other thing is you might be thinking about a question or something like that, or you might be confused about a particular nuance that I'm talking about and miss some of the other things I'm talking about along the way. So when you watch it again, that stuff will come back around and you'll be able to remember it. So please watch it again. I'm telling you, it will help with your memory and understanding for sure. If you wait a month down the road, it's going to be like learning it all over again. All right, my name is Eric Wilkinson. I got to get a couple of things out of the way real quick. You may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned and trying to get a psychology degree, switched it over to finance, and then after graduating with a finance degree, I moved to Chicago and started working in the pits of the Board of Trade and sold all my stocks, bought a badge, and started trading on the floor too. So in that time, I've traded just about everything: stocks, financial futures, commodities and currencies, options, all that stuff. This disclaimer basically says any opinions, news, research, and analysis or other information contained here is for general commentary and does not constitute investment advice. All right. The reason why I can't give you investment advice, guys, is because I don't know what your risk parameters are and I don't know what's in your portfolio. Therefore, I can't give you investment advice. There's no way. And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. You can follow me on Twitter at Wolfman's blog, especially during earnings. I tweet out what my earnings trades are going to be, the directionality anyway. I'm not going to give you the strike location. You guys should know the strike location from watching the earnings webinars. I don't want to give it out to everybody on Twitter. I'd give it out to you guys. That's fine, but I'm not giving it out to everybody. And you can follow our parent company at Pro Trader Strat for all kinds of market wisdom and everything else. Trevor's in the house, giving me the wolf. All right. This is on the Iron Condor, and I will mention this immediately. You're probably only going to use this maybe 2-3 times a year. All right. Everything's got to come into a line for this. Because it is a low probability strategy, we need to make sure that we increase our probabilities of success by the way we set it up. Now, we're building on the long strangle. So with the long strangle, we had to have low implied volatility for one. That was a big aspect of it. And we were looking at that 30-ish delta. We're still going to do that same steps where we're going to be looking at a 30-ish delta. And one thing to note is when we're doing this strategy, this is what this long strangle looks like. And it's because it is undefined to the upside. So you have unlimited profitability to the upside. Obviously, it's going to seem like it to the downside, but it's going to be to zero. But one thing we want to make sure of is when we're doing this, we do it in low implied volatility so that these edges get as close together as we can. You know, we want it to kind of almost look like a V if we could. But then we build on that. We add some short calls and puts to this strategy. The reason why we're adding this to it is because it lowers how much we have to pay out for it. All right. And that's really what we're trying to do here. It's a low probability strategy. We add these shorts in there to lower what we paid out for it. Okay. So that allows us to get to a closer break even, right? When we add something like this, our break evens are going to be basically the put minus the debit we paid or the call plus the debit we paid. With this, it's the same idea, but because we define that risk, it makes us pay a little bit less for that debit. And these are two different stocks, but I want to show you what the Analyze tab looks like with the defined aspect on the Iron Condor, selling those out of the money calls and out of the money puts. This one does not have the out of money call or put, whereas this one, you can see the defined risk. We know how much we can make. Pretty simple. We will build upon that and talk about strike locations here more as we go along. All right. Essentials to success. One of the first things we need to look at with this strategy is the environment in which we are in for this underlying. And if the environment isn't appropriate, then we don't trade this strategy around that underlying, okay? So for XYZ, picking the right environment, we need low implied volatility percent, okay? Right now, across the board, we have high implied volatility and high implied volatility percent for these different underlyings. That being said, it's going to be difficult to find the Iron Condor. We want something where we have really low implied volatility percent in and around this underlying. It also not helping that we're coming into earnings. That's given us a little bit more volatility as well. But this is a great strategy setting up for coming into earnings season because we don't care. We want that volatility to expand on us. So when we're picking the right environment, we want low implied volatility percent, but the expectation that it will increase. Okay. And going into an earnings or a binary event, you guys, those binary events carry more volatility with them because it's unknown. Anytime there's an unknown, there is volatility. So a binary event is just something that affects that underlying specifically. An earnings would affect XYZ specifically. FOMC, when we have the meeting for the FOMC, that binary event is for the financials, okay? It's going to affect the financials. It'll affect the stocks a little bit as well, but more so the financials. So we want really low implied volatility percent. And for a stock, you guys, we want it to be below 30. And for an ETF, we want it to be below 15. Okay, that's green light, full green light for this. Below 30 for a stock, below 15 for an ETF. It's about half of what I normally talk about, all right? Because we need super low implied volatility percent for this one. And if we looked at it for a stock under 50 or an ETF under 30, those would be yellow lights, okay? Anything above 50 for a stock would be pretty much a red light for me, okay? Unless you were having an earnings around the corner and really expected volatility to spike going into that. All right, so when we're talking about this low implied volatility percent for Nike, let's look at it. It's like a $50 stock here. You can see where implied volatility is really low. The legs we were able to look at are pretty tight. But then when we look at a similar price stock with really high implied volatility, you can see that those legs would be really far away. So we don't want that. That's really hard to achieve to get out that far, right? Wouldn't you rather only have to get that far? That's what we're looking at. That's why we want low implied volatility percent. Picking the right underlying, you guys. So when we're talking about the right underlying, we need something that has a stock that has tight markets. And we go to the monthlies that are closest to expiration, 15 days, really the spot month. One could call this almost a pick'em between these two as the spot month, but we're going to go to the closest to expiration. And we want these markets to be on a stock under $100, 10 cents wide or less. And for a stock over $100, we can look at Home Depot, and you move the decimal place 3 ticks to the left for a stock over $100, and it should be 18 cents wide. You can see it fits that rule. So stock over $100, just move the decimal 3 ticks to the left. That's how wide these markets should be, tighter than that even. All right. And if it's under $100, 10 cents wide is what we're looking for. All right. Stick to that rule, especially if you are a newer trader. If you are a savvy trader and been around and you know particular stocks that don't fit this rule, but you've gotten comfortable trading them, then that's okay. But this is really geared towards the newer trader. And I stick by this rule to this day for the most part. There's a couple occasions every once in a while where I'll stretch that. But all in all, on any given day, I'm making sure that rule of thumb follows through. So over $100, move the decimal 3 ticks wide, under $100, 10 cents wide. That's what we're looking for. Okay? For picking the right underlying. Picking the right duration. Because we're doing this as a debit spread, anytime we're doing debit spreads, we want longer duration. The reason why is we have less theta decay. Theta is the thief in the night that comes and steals our premium. And you can see that that thief gets a little bit more aggressive the closer to expiration. So we want to give ourselves that time and be out here in this area, somewhere outside of about 45 days to expiration. It's wanting to change my thing rather than giving me a pen. So we want to be outside of this 45 days to expiration, right? You can see that the slope is much less. That means our premiums are going to decay slower, and that allows us more time to be right. Inside of here, if we put that trade on, we're going to start needing that movement to happen very quickly in order to outpace our theta decay. Out here, we don't need that much of a movement to outpace our theta decay. So get out here. We can look at it on the platform as well. We can see theta decay inside of like 13 days is, 10 cents to 13 cents right here on these at the monies, which is the ones that we're going to be, or just out of the monies, which is the ones that we're going to be playing with, right? 13 cents a day. Whereas if we go out further in time where I'm talking about, you can see that the theta is less than a third. It's about a third of what we were seeing. So 3 days to catch up to the 1 day inside of here, okay? We want to limit that theta decay. Excuse me. So the January is probably where I'm going to be looking to go. It gives me a lot of time to be right. It gives me less angst on having this strategy move quickly because of the theta decay, okay? We want that theta decay less. So go further out in time, all right? Picking the right strikes with this one. What we want to do is we're going to start around that 30-ish delta, kind of like we did with the Strangle, but we're going to lean towards closer to at the money. It's going to be closer to the 40-ish delta, but, we're going to try to hit the 30s, but, the higher 30s is what I'm leaning for here. So deltas in the 36 or higher for the most part, maybe closer to 40-ish delta. And then when we build this out, we're going to try and do it to where we risk one to make one. All right. And I'll throw up an example real quick of one that I looked at earlier, and it's in Twitter. So Twitter, we look at, let's just say I have expectation that it's going to have a larger than expected move. I feel like it's ready to break out, has low implied volatility. So I'm going to go out here further out in time and look at those 30-ish deltas to try and determine where I am going to start my strategy. And I'm going to probably lean towards the 40s right here. Let's go with the 37s. So I'm going to buy the 38 here, and then I'm going to look at around that 30-ish delta here, which is probably going to be the 33s. It's the high 30s, right? So I'm going to buy that one. Now we've got our Strangle. We need to create the Iron Condor, which is that short call and short put. Well, we got $3.78 here. So we're thinking we probably need to make these about $5 wide because I need to risk one to make one. If I have $3.70, that's putting me about $5 wide. I'm doing this based on the premium, getting that down to $2.50 from where I am. So if I go $5 down, that's selling the 26s or 28s, So we'll sell that one. And then $5 higher, that is $5, right? $5 higher there. And then $5 higher from the 38s puts me at 43 short. So if I can get that 43 in there, sell the 43 in there. Okay, so $5 wide to the upside, $5 wide on the downside here, and I've got $2.40 some odd cents. So that's right in line with that rule. We're paying slightly less than 50% the width of the strikes, which is all right. That's what we're looking for. We're shooting for that target. So this strategy would fit all of those rules. We got low implied volatility. Other than Twitter, I'd like it to be below 30, but as you can see, there's not a whole lot below 30. That would be the green light. So this is a yellow light on it just being slightly above 30. All right. Expectations, volatility is going to, I am long, Trevor's saying I'm long Twitter. Well, this is a good strategy if you're worried about that Twitter trade too. Not that I would necessarily throw this around a long Twitter trade, but this is just for a breakout in either direction. And we got that down to our 50% of max profit. Now, how do we get out of this trade? 50% of our max profit gives me a 50 $2.50 on the last one. I'm looking to get out of this strategy when it's increased by 50% of that debit paid. So in a sense, when we're paying $2.50, 50% increase would put that at around $3.75, right? So that's where I'm looking to exit when it increases by 50%. 100% would be a double on this, right? And there's no way you're going to ever get this Iron Condor to get that full width of the spread. It would have to literally just land on your short call or short put and expire right there to get the full bang for your buck. This trade will take a little bit longer usually to mature and get to that point of that 50% increase in your profit, but that's what we're looking for, all right? We're not riding this into the sunset and trying to get the full width. All right, your max profit, we talked about this briefly. Max profit is the width of the spread, and in that previous case, $5 wide minus the debit paid, which was $2.50, let's call it. So our max profit is $2.50. Max loss, obviously that debit paid. Anytime you pay a debit for an option strategy, that is your risk. You have that note going into it that you know that that is the risk. And then finally, our break evens. We're going to have two break evens. It's going to be the underlying price is at expiration. This is expiration, the long call strike plus that premium paid, or the underlying price minus the long put minus the premium paid. All right, is our break even. So we can look at that on this chart here, and just kind of go into the analyze tab and just kind of flip through these to make it easy. Does anybody have any questions right now so far? So let me squeeze this in so you can actually see the defined aspect of it. You're gonna let me do that? It's not gonna let me go. Come on, baby. Squeeze in there. Now slide. All right, so there's our defined aspect. Basically risking $2.40 to make a little bit over than $2.40 on the upside, all right? Now our break even is this 33 puts minus the $2.43, which puts us at $30.57. Should be right around here, $30.57. And then to the upside, we do the, what was the call on the upside? It was the 43 call on the upside. No, sorry, 38 call on the upside. 38 call on the upside plus the $2.43 gives us $40.43 to the upside, and that's our break even. All right. And we can achieve our 50% increase in this value just if the volatility starts going up. As you can see, as I start cranking up this volatility in our strategy, this purple line starts getting up and away from this value line, which is the zero value, right? That's where we're not made money or not lost money. And when volatility increases, even if the underlying doesn't move, the days to expirations don't change, you can see that I'm already starting to achieve profitability. So that's why we want that to go up. If the volatility were to start to go down into, say, let's go into negative territory, you can see that purple line starts going below, and we start getting our break evens to start moving because the premium is coming out quickly. All right, so we don't want the volatility to come out. Now, what I was talking about with the implied volatility percent, you guys, is we need this implied volatility to be really low. All right, and you can see it's not super low, which is what I'm talking about. I would really like to get involved in this strategy when it's really low down here, but we could say that we expect this volatility to start expanding. And that's what I would need to have in order to implement this strategy. I would have to have the assumption that volatility would expand, all right? But we need to figure out the implied volatility percent, which is this number right over here, 38.06. There's an easy way to figure it out also. If we go over to the options chain and look over here, current implied volatility percent, 38. Well, what all that is saying is where implied volatility for this particular underlying is right now in relation to where it's been in the past. because they all have a tendency to have extreme highs and extreme lows. And, you know, this is a little bit higher than normal. But you can see it has a tendency to stay within these ranges on the highs and the lows. And every particular underlying will have this type of situation. It's not always going to be where, you know, 80 is the high and 30 is the low. Sometimes some stocks, 30 will be the high for that underlying, okay? So what we need to figure out is, where is this implied volatility percent, or implied volatility percent? We need to figure that out. So we take the current implied volatility in the numerator. We have a sum that we divide by the denominator's sum. So in the numerator, the sum we need to find is the current implied volatility, which is 53, minus the low implied volatility, which is 30. So we have in the numerator 23, divide that by the sum of the high, which is 90, let's call it 90 minus 23. So 90 minus 23 is 67. So we had 50 minus 30. So 23 divided by 57 puts us right around 40 with my math, but it's a little bit lower than that with the actual running out all the decimals. So you can do that math that way. That tells you that right now we are in about the 40th percentile of where it's been in the past, and they will have a tendency to stay somewhat within the range. They will break out a little bit at certain occasions, like this one did, but for the most part, they want to stay within that range. Does that make sense? Is volatility the main reason for this kind of trade? Could you also consider a calendar spread in this case? Yes, I have certain rules, Peter, for my calendars and things of that nature. So especially with calendars, because there's different volatility coefficients for the different months, I have rules in and around that you would need to check out that I don't have really the time to go into right now. But definitely check that out, because the calendar has some other nuances, especially with volatility. But to answer the broader questions Peter's asking about volatility being the main reason for this trade, the main reason for any of my trades is volatility. That is one of the main reasons. I don't necessarily even have to have a market directional assumption. I sometimes will look at my portfolio, see I don't have enough short premium strategies in my portfolio, and I just go to the highest implied volatility percent that I can find and start looking for something to put in and around that. All right. So in this case, this would be when we have really low implied volatility percent, then that's when I would be looking to implement the Long Iron Condor over, let's say, a Strangle. Maybe the Strangle would have a slightly higher implied volatility or along those lines. Does that make sense? Okay, good. So in this strategy, for implied volatility percent in the numerator, where the current implied volatility is minus the low, take that sum and divide it by the high minus the low. And that's where your implied volatility percent is, if your platform doesn't give that to you ahead of time. Okay? Does that make sense? All right, good. All right. So throw out a couple of examples in the questions box if you guys want me to go over a couple of stocks that you like to look at. I'm going to look at one more that I was checking out. CMG. A lot of times this strategy works better with some of the higher price stocks. But implied volatility percent for this one is right around that same 40. It's really hard to get something really low. You know, when you get into the single digit stocks, this strategy will not work. Like I said, it works better with the higher price stocks. CMG, we can look at, go out to that January. I'd like to get a little further out. Like I said, give myself time to be right and the room. So I'm going to start out with that 30-ish delta that I was talking about. So 36-ish, close to 40 if I can. So I'm going to start out with this one. So right around the 36-ish delta. So that'll give me around the 455 is what I'm going to go with. So buy that one because that's around the 30-ish delta. So then I've got about a $30 credit. So in that, I'm thinking I probably have to go about $50 wide in order to get this to work out, to get that down to about $25. I have, $7 to pay is kind of what I'm looking at. And that puts me at around $50 higher because look, $3.50. That's right around that $7 that I'm looking for. And then $50 to the downside gives me this one. That's a little bit tight. I might have to play around with these strikes because it's not going to give me that 50%. If I go $50 down, it's going to be a little high for that one. So the $50 wide here, $50 wide here, paying $2 or $22, slightly less than 50% of the max profit, or 50%, but that puts me in and around where I want to be, right? It's less than, it's not more than. We don't want to go over that. So that will work for this trade. Volatility is dropping big time for a calendar. Yeah, it very well could be. I haven't looked at it. Good to see you, JQ. All right, so that's how we would work it. A little bit less than 50%, the width of the strikes. We're paying $22 to make 28. All right, so that's what we're looking for there. We want to try and go a little bit tighter than we normally would otherwise. So that was at 36. We can even look at the 40s. So let's go to the 95s just to see if this works out a little bit better. The 60s. So I bought both of those, $36. So again, now I have about $10 to spend. So to get to 25. So let's go about $50 higher again. That gives me to the 45s, sell the 45s, and then going $50 lower gets me to the 410s, sell those, and 24. So that one's a little bit better, actually. You can see 50% right there. So play around with it so you can get as close to 50% as you can. And by doing that, I was able to get a little bit tighter, right? Which is what we want. I want this strike to go in the money. I actually want this strike to get tested. So some of the things we look at, if I'm buying that, what was it, the 495, the 495 strike here, it's a 40 delta. So I have a 40% probability of being in the money at expiration in the next 78 days. But in the next 78 days, I have an 80% probability of CMG. This is just a floor trader hack. You're going to have to believe me on this. 2 times the delta is what the probability of just being tested. And if this market rallies up and this goes into the money, even by a few ticks, we're going to be very close to that 50% increase in our premium relatively quickly, especially if it happens right away. So as soon as that goes in the money, we're going to be looking at trying to cover this trade. And same for the downside. And all the way to the point where this 2 times the delta, there's a 30% probability we go all the way up and give that a kiss. And that's definitely where I would be looking to cover that. If my short call or short put gets kissed, as soon as those short call or put gets kissed, I've beaten the probabilities, you guys. I'll take whatever credit they're giving me at that point. All right. It may not be a 50% increase because maybe it's so close to expiration at this point that we've lost a lot of theta decay and stuff like that. But as soon as that short strike gets kissed, look to cover that, because know that you beat the premium or beat the probabilities on that strategy, and need to be thinking seriously about moving on. Does that make sense? So you're doing the Condor for a debit, not a credit. Yeah, we're doing this Condor as a Long Iron Condor. And one thing I preface with the Long Iron Condor is you will maybe find 2, possibly 3 occasions throughout the year where you're going to implement this strategy. And I would stick to that, you guys, because it is a low probability strategy. If you got vol in the teens for an underlying, this is a great strategy to put in and around that, because we'd expect volatility to expand. You don't have to worry about earnings with this strategy other than covering it before that earnings event. Don't wait until after they release, because after they release, volatility comes out and that can hurt you, even if you were directionally right. So just cover it before that earnings event. It's not worth risking profit when that happens. All right. So that's a couple of examples, good examples that I went through and found for this one that we could do. So if it doesn't work out in the 30-ish, start going a little bit closer to at the money. Yes, you are going to have to pay a little bit more, but the reason why we can go closer to at the money with this strategy rather than with the Strangle is because that short one that we're selling, these short strikes, are probably not going to go in the money. They're so far out of the way and such a low probability, and that would be a great problem to have. But that's why we want to get a little bit closer. That moves our short strikes a little bit closer, lowers our net debit we paid. This would be, another $11 higher had we not done the short strike. That means our break even has to be $11 higher than where we are now. Okay. That's why we want to sell those call and the put to limit our risk, because this is such a low probability that it's going to happen. If it does happen, I'll be happy, very happy. and I would take my profits and run. All right. Does anybody else have any other questions or want me to go over any other examples here? XLV is a little bit high here. Coca-Cola wasn't really working out very well for me. We can take a look at it, though. Earlier when I was trying to vet it, it wasn't working out too well. Oh, that's why, because the strikes start jumping here on this. Goes pretty wanky, but $2 wide. So if we did the 40s here and did the 40s here, it's $1 wide on that, right? We got $2. So if we go about $3, we might be able to achieve this. And that's why we need the 51s, I think. And so go $2 there. $2 wide. It's not very exciting. That's why I stayed away from that one. I'd like to go to the $3, but it doesn't have that 51 strike right now. So you could definitely go a little bit shorter duration, check it out also and buy that one. It still doesn't have it though. And then do the 40s here. So buy that one, go $2, sell that one. $2 wide, pay it $1. So, but that one's not very exciting. That's why I was saying, it's a little bit easier to do these with the higher price stocks to get a little bit wider width on the strikes. Usually maybe over $100 is a little bit easier to start building the strategy out. But you could definitely do this one for, $1 win. When you're paying that little on these lower price stocks, that's what I'm thinking. I'll just do the Strangle or the Straddle for that little debit I have to pay, and then have the unlimited possibility to the upside and the downside is really the way I'm looking at it. But something on, Netflix or Tesla and those other bigger ones, when I can lower my break even by a full $11, that's a pretty substantial correction, right? To make up for it. You want to do BIIB, Biogen. All right, so let's look at Biogen. It's 44. It's below 50, so we'd have to say it's a yellow light. It looks like they have earnings coming up, so that's good. That will help us. Volatility should start to expand for us. So we're looking at Biogen, 3 ticks to the left, 31 cents wide, and usually Biogen is pretty close to 30 cents wide. They're a little wide though here, so I'd probably have to pass on this because you can see they're still 30 cents wide here. If during the day session, I think Biogen a lot of times has tighter markets than this, but it doesn't fit my rule right now. If this is something that you really like to trade and you're used to dealing with that kind of risk, which I wouldn't necessarily, because this is the reason why I think that 30 cents wide should be the reason we go with that. Because if I have to give up 30 cents even to get into this, so I'm having to give up 30 cents to the downside to sell $13, right? That means this guy's got to give up 30 cents to the upside. I might have to give up 40 cents, maybe even sell it, 1290s. But let's just say I sold the 13s. I gave up 30 cents edge. That means I have to wait 3 days with nothing, if nothing happened, for my premium, you know, for me to make up for that premium. Actually, it's going to have a big move in order for me to make up for that premium. But you have to give up so much edge to get in and get out that it doesn't make it worth it. Does that make sense? If I gave up 30 cents edge to the upside, I'd have to have almost $1 move in order to get just to my break even on that one strike, right? Because if I paid $13 for this one and $1 move gives me an extra 40 cents, that's getting me back to where I got in just for a scratch. So it's very hard to achieve that when you have to give up those big edges on both sides, right? Knowing you're going to have to give up 30 cents edge to get in and 30 cents edge to get out. I try and stay away from that. Okay. I do believe that it usually has tighter markets, but for right now, let's say if it's not following through with our rules there. So is this a hedge, Strangle? It's not really. I mentioned, Trevor, earlier when you were talking about being long Twitter that you could throw this in and around that, but I wouldn't, to be quite honest. The more I thought about it, don't do that, because if you're buying this strategy, you're increasing what you actually paid for Twitter. So I would stay away from that. All right. All right, guys, we've reorganized everything. So we've gotten this so it's streamlined for you guys. Everything's reorganized. And because we've done all that, we want to try and get your guys' feedback and what you guys think about it. So if you guys have enjoyed my presentation, take advantage of this, especially if we're in the middle of if you like to trade for earnings or thought about trading earnings, we're right there right now in the thick of it. I'm talking about earnings trades and other trades that I put on. So take advantage of this premium membership offer for $7, 1 month. Can't beat that. It's in the chat window. I just clicked on it. You can easily click on that. If you're watching this on tape delay, you're going to have to pause and punch it into your URL. But with all of this, you not only get all of these things, you get unlimited access to me. You can call me, you can write me. If you have an issue that you want me to talk about, what I would do, what my rules are in and around something, I will reach out to you. I have a no inbox policy. As many of you guys that are watching this know, I respond immediately to you when you guys are needing an answer. Also, there's well over 50 videos on the options trading workshops in the archives. Like I said, we've reorganized it. Basically, once you get done, there's probably 10 inside of this particular drop-down menu. But once you're done, you just click off each video as a check mark saying I've watched it. And then once you're done with the section, you get to check it off completely so you don't watch the same one over and over again. Have I seen that one? You also get these little 15-minute videos that we've been doing where you it's a brief overview of the rules in and around each strategy so that you don't have to watch the whole thing again. I would suggest watching the full webinar shortly after watching it this time. And then, you know, if it's a month down the road, refresh your memory with some of the other shorter 15-minute videos, all right? And you also get access to the webinars, early access to the webinars as well. So you get all of that stuff for $7 for the full month. If you have any questions, you can reach out to us at 310-598-6677 or trading@protraderstrategies.com. All right. So I want to thank you guys all. Later webinars, I'm going to be drilling down on different option components, how I trade options, when and where I find them appropriate. Here's also that link that is not a hot link. You'll have to pause the video and punch this into your URL if you aren't just clicking on that easy chat window link. We've been going back and forth in the questions box, you guys. The chat window is a little separate section over there that you'll be able to see when I throw stuff in there for you guys to go over. And I just put it back in there again. All right, so reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. It goes a little bit quicker when you guys don't have a whole lot of questions. But take advantage of this. If you learned anything at all, you will learn something new this month if you take advantage of it. I can almost assure you. Can't guarantee anything because they will come after me, but I can assure you that that is going to be the case. All right. You guys have any other last minute questions out there for me? I see one coming up. Are the recordings of your past webinars free, just like this one? The ones that are all on there for the $7 archives, all of those you will get for that. Yes. And Klaus, if they haven't sent you the link to it where they have in the past, reach out to us. Call us at 310-598-6677 and let them know for sure. All right. Cool. That's all I got for you guys. Take care. If you can't take that, take it easy. Bye, guys.